Hedge funds are up an average of 9.8% through May of this year. That's a lot better than the major stock indexes, but not all funds are created equal. Many funds that place short bets are smarting from the global market rally, preventing them from being able to charge what traditionally have been large fees. And we saw another casualty when the multi-billion-dollar hedge fund player Cantillon Capital said it would shut down its long-short funds. Now, will more funds follow suit and pursue what is effectively a long-only strategy? We now ask Jacob Schmidt, who is a hedge fund advisory firm, tracks these trends very closely. He joins us from London. Jacob just mentioned Cantillon. Do you think we will see more of the long-short funds that have made money in the downturn because they had been short abandon that strategy now that they're getting so badly burned and go long only?
Yeah, Cantillon, I think it's not a trend, but it's certainly a development that we're seeing, that hedge fund managers think that at this point in time there's more to make on the upside than on the downside. Let's not forget that obviously over the last year short selling has been very volatile, difficult. You could make quite a lot of money, but you could actually also lose quite a lot of money by being, caught on the wrong side. Cantillon has been a fantastic fund. Also the manager, very experienced man, has been doing this for over 15 years. So the question here is why is he doing it? I think there is a generational thing that after 10 or 15 years you might see the business opportunity somewhere else. And that's what we're really seeing here, that the opportunity was somewhere else, is rather on the long side than the long short side. So it's a change in the business strategy, which makes sense.
Now, when you're a long short fund, being able to go short and of course getting some leverage is what distinguishes you from, let's say, an investment advisor or even a mutual fund. If a long-short fund goes long only, what's really alternative about it? Can you really call it alternative asset management any longer?
There has been a certain trend of hedge fund managers actually looking at so-called absolute return products and shorting less or not shorting any longer, and really just looking at the absolute return side of the equation, being the long side, because as you know, you make much more money if you're right on the long side than on the short side. The shorts are either protective or provide additional income or alpha. So we've seen managers, established managers, who have looked at absolute return funds and have been very successful with that. What is alternative about that? I think it's semantics. It's a question of philosophy. If you're good at that, if you pick it, it could be still a very good product.
Jacob, as we mentioned, hedge funds up almost 10% through May. Assets rising for the first time in 11 months. Does this mean that the phase of redemptions that we saw, the vicious redemptions over the past year, are over and maybe hedge funds are back as an industry?
I think the vicious circles of redemption is definitely over. There's still a little bit to come out of the side pockets and all the gated money. However, the long-term investors, the institutions, they're definitely in here. They're allocating again. They're not moving out here. But obviously there are strategy changes. People are very, obviously thinking about where is the next move, where are the opportunities. But I think the redemptions are over, but it's now looks a little bit different from the last few years.
We've only got about a minute left, Jacob. So many institutions were so disappointed with the way that hedge funds handled the downturn, putting up gates, limiting redemptions, etc. Will we ever see pension funds invest in hedge funds the way that they did during the boom?
Oh, definitely, and I think we see actually more pension funds, institutional investors now looking at hedge funds, obviously with more demand, so it's now very much a buyer's market rather than a seller's market. So the buyers now, the pension funds and the fund of funds, they are now really very much dictating the terms in terms of fees, gates, redemptions, liquidity, and so forth and so on.
Very quick question. Fees, the traditional model, 2 and 20, what's the new model?
I think the new model is more towards the 1% and the 15, could be as low as 10, but I think talent still can charge 15 or even 20% performance fees. No longer huge management fees, however.
All right, Jacob Schmidt, hedge fund expert, thank you so much for joining us this morning.